Welcome to Navigating Equity Compensation, a webinar series hosted by Countsy. Today we discuss how to prepare for the auditors. Our guests today are Don Gelati, General Manager at Insight Software, the owner of Certant, and Todd Marcus, Chief Accounting Officer at Countsy. And Corrine Schneider, Founding Partner at Compass Strategic Advisors, will be today's moderator. We hope you enjoy this conversation. And Corrine, now over to you. Well, welcome everybody. I find always interesting topic is preparing for the auditors. I'm really excited to have Don here, who, as we said, is the General Manager of Certant Equity Management. Certant's been a brand and a solution that's been around for a long time. I don't know how many years, Don, has it been?
More than 20.
More than 20, okay. And Todd Marcus, who is Chief Accounting Officer at Countsy, but also runs the technical accounting practice. So could not have two people who know more about this topic. And I always tell Don, I hope you take this as a compliment, but as somebody who is not an accountant, you know more about technical accounting in the equity compensation space than most accountants do. So excited to have you both on. We thought we picked this topic, preparing for the auditors, because I think it's something that everybody gets anxious about and knows has to happen. It's one of those like preparing your taxes every year, but most people kind of wait too long and put it off. And we see a lot of issues, and frankly, it's a big cost for companies, especially if you're not prepared. So welcome to you both, and I think I'll just jump into the questions, and unless there's anything you guys wanted to say in terms of introducing your backgrounds, anything that people should know. If not, I'll just jump into it. So maybe Todd, we'll start with you. What are the most common areas that an auditor is going to be looking at when they come into the equity comp space? And we're just really keeping this for the stock plan people in this particular webinar. But what are they generally coming to look for?
Yeah, it's a good question. And I think while designed for stock plan people in particular today, I think what the auditors are looking for in that particular area is what they're looking for in everything that they're doing. And it's the complex and unusual stuff that tends to be their focus. That tends to be where the risks are, where management has to insert some judgment, or where transactions are just really difficult to navigate. It's not your plain vanilla grant of a normal stock option. So as we think about equity specifically, I think about modifications for private companies, secondary sales that may have a compensatory aspect to it. The classification of awards as liabilities or equity can always be a very complex area. And issuance of any type of awards that are just sort of outside of the norm. So you think about performance-based awards or market-based awards would fall into that category as well. I'll probably talk a few times today about how I think when you think about what they're focusing on, it's that area of management judgment where human beings are getting involved in the process. So it's things that are happening outside of the system in terms of calculating expense or putting together disclosures. That tends to be an area of focus for the auditors. And then we find certainly just completeness. Did everything that actually happened during the quarter, during the year, actually make its way into the accounting records? So think about, for example, grants of options that are delineated in board of director minutes. Did those actually make it into the plan? Terminations that the HR department might be keeping track of, have we appropriately reflected those in the plan as well? I think those are some of the things the auditors tend to focus on most.
Got it. So Don, obviously Certant provides a system that people use to track their own plans. And I would guess most of your clients are doing this themselves, managing the plan versus outsourcing it. Although I know you have a lot of partners who will use your software as well. So let's start with what Todd just said, making sure that all this information is in the system. What would you recommend to your clients who are using the system or people who are thinking about using their own system in terms of preparing for the audit? How do they make sure it's all in there?
Yeah, it's a great question. And the first way I would respond to that is if you're using Excel, whether you're privately held or public, get onto a system. The value is there, the ROI is there, and most importantly, the controls will be there, because most accountants, I think, would agree it's virtually impossible to deliver appropriate controls in the financial statements and in the operating environment if you're using Excel spreadsheets. They tend to be harder to audit because everybody does it slightly differently. There's no sort of uniformity, whereas I think auditors are familiar with a variety of the major systems, and certainly Certain is one of the major software systems for public and private companies. So that's a big part of it. And then coming back to something that you said at the beginning, Karine, it's prepare, prepare, prepare. I think companies do get caught flat-footed sometimes, and the more they prepare and the further in advance they prepare, I think one, it'll just go easier. If we can talk about an audit as being easy, but also it may even reduce the hours because you've got your ducks in a row, you've got your homework done prior to the auditors showing up, you've got a good idea of what they're going to be looking for, which to me, and this comes out of good systems, ours and of course others, backup, backup, backup. So for example, grant agreements. We have all these grants in the system, they show up in the income statement, but where's the backup? Where's the paperwork or the electronic paperwork? Is it signed? Is it dated? That gets us to the notion of, do we in fact have a grant agreement? Have we met all it sounds simple, but it can be pretty complicated to understand whether, all parties know everything and it's considered that we have a grant agreement. The other one is just having backup calculations to your reporting. So whether it's fully diluted EPS or it's the footnote and roll forwards where you have, 30 or more lines of calculations, being able to drill down into all of those and see the backup behind them. And so that's something that our system prepares people to do, because for those major financial statements, we've got the backup data behind them at a literally grant by grant level in terms of the footnote, or things like, again, in fully diluted EPS, there's about 14 calculations. But what you want to see is, okay, what did each of the grants contribute to that? And so I think the audit approach would be to take a fairly good sized sample, but they're not going to look at, thousands of grants line by line, but pick a good reasonable size sample and test on that. And when you have that kind of capability out of a system, it makes it much easier to provide that for the auditors and be prepared adequately.
And Karine, if I could just tag on to one thing Don said there, I think when you think about this idea of what are the common areas that auditors are focusing on, going back to Don's original comment about Excel, if you're using Excel to try to do all of this, you've got a massive target on you just because of that. That right there in the auditor's planning stage is going to be an area of risk they're going to identify. And I think especially when you're talking about equity plan accounting, even if you only have a relatively small company with 20 employees, if you're doing grants and refresh grants year after year, it doesn't take long before you're trying to track against hundreds, if not thousands of different grants. And that is a problem that is just waiting to happen. It's not a question of if, but when. So be wary of using Excel.
And Todd, how far back do they go when they come in? I mean, is it just really the last 12 months, or can they, that's the complexity with equity plans, right? You can have a 4-year grant with a 4-year vesting. So how far back, as Don says, you got to have these documents, you got to have this backup. How far back can you expect them to ask?
Yeah, and Karine, you just touched on it right there. If you think about a typical grant that's got some kind of vesting period that approximates 4 years, and we're looking at the current year, that's how far back they're going, because those grants from 4 years ago are still impacting the company's results of operations in the current year. I would say for companies out there, private companies that may be going through an audit for the very first time, the answer to that question is everything you've ever done in equity is fair game for that first audit. If you think about the balance sheet in that very first audit, it reflects everything that has happened since the very first day that we granted shares to the founders, or awards of some kinds to the founders, and everything that's happened after that. So if we converted safes or converted notes or granted warrants, all the options that have been issued historically up until the most recent year are fair game as part of that audit, because they are, or should be, reflected in the balance sheet through the current period.
Yeah, and if I could just add to that, Karine, and Todd, help me out here if I get out over my skis, but let's just say you have a 4-year stock option that's vested, but no exercise. And so now you have a 7 or 10-year life. If you are in a position to be accounting for a deferred tax asset, then it's more than 4 years, because we have to know, does that asset live on the balance sheet? Does it stay on the balance sheet? When does it come off? So it could arguably be longer.
Absolutely. And then there's a bunch of disclosure requirements that hang off of that option being outstanding for as long as it's outstanding. So it's a great point.
Which could be 10 years, right?
Yeah, right.
Yeah. And I remember from my stock administration days, one of the biggest problems we always had was knowing if someone was terminated. And the auditors would come in and say, are you sure that everybody who still has an outstanding option is still working for your company? And, when you're just a small, like you said, 20 people in the company, small private company, you might feel pretty confident answering that. But let's say you're a big global publicly traded company. How do you feel confident? Don, are there tricks now in the software, or is this, why you need to have an integration with your HRIS, or what do you see there?
Well, integration with HRIS is nice, but in the profile of the company that you just laid out, most of them don't have a single global HRIS. They can have a couple, they can have 5 or more. So that's where it gets pretty tricky, because how many of those systems are you going to truly integrate into your stock plan system? And if not, how are you going to get all that data that you need in terms of, is somebody still at the company? Yeah, that's very important. And then you get into the business of mobility. Have they moved? Have they moved around from one country to another? Are they expats? And all of those things can affect certainly at least where you expense within the company in terms of cost centers and so forth. It can affect recharge agreements if you have chargeback in place, and you kind of need to know that. So with the large global MNCs, it's a very difficult problem to solve, again, simply because most of them don't have a single HRIS, which they can then just easily plug into their stock plan administration system or vendor.
So Todd, I assuming Countsy helps its clients manage things like this. Do you guys have tricks or tips, or what can you share in terms of how Countsy gets their clients ready for the auditor?
Well, I think there's a couple of things. There's maybe not like one fix that gets everything or one tip that gets everything, but it's certainly some themes that we've talked about already in the short time we've been together. It's about preparing and getting in front of some of the things that we know that are going to happen. So I think what Countsy really focuses on are, number one, the complex or unusual transactions that have happened during the reporting period. Ideally, we would love to tackle those kind of as they happen. Those problems don't tend to age very well. So to the extent that we're completing some of those things mid-year, mid-quarter, getting in front of those before we get to the rush of a quarter end or a year end reporting cycle and trying to manage everything else related to the audit, dealing with those. I think on the reconciliation side, you touched on it, terminations tends to be one of those gotchas all the time that pops up. So we really focus on working with our HR partners to make sure we've got that information in front of us and are reconciling that against the records that we have. And then I mentioned it before, I'll come back to it again though, because it tends to be a gotcha that we see quite frequently. And that is just making sure that when we're passing over minutes to board meetings to the auditors as part of their PBC requests, that somebody from the accounting side of the company or somebody on the Countsy side has actually reviewed those board minutes to make sure all the different awards that were granted in there line up and agree with what's been put into the equity admin system.
Yeah, that's a really good point, because I know the lawyers are trying to document things in the way they think is appropriate, but it's rare to find a lawyer who has a background in accounting. So, that they, or paralegal who would understand that.
Absolutely. And a lot of times what we see is, it's a standard request. They're always going to ask for that. And it may be that the CFO or somebody very senior in the company is the one who will furnish that information. But that person is likely disconnected from the details of what's in equity accounting. So making sure there's somebody kind of in the middle there that understands, here's what we provided the auditors that they're looking at, and can reconcile what they're looking at in those board minutes to what actually made it in to our equity accounting system.
Right. Yeah. So Don, I assume then in that case, just to follow it all the way through, you want to check the minutes. And then you want to make sure you want to run some reports. If you're using certain, you want to run those reports in the certain system and then share them with the auditors. Back in my day when I was preparing for the auditors, one thing that they always wanted were PDFs. I would give the auditors, an Excel spreadsheet, or I would print it out in Excel, and they would say, no, it has to be PDF because we want to make sure you haven't changed any of the data. Are those the types of things that your system is really sensitive to? That I know you've built the system to track stock plans, but I assume you also have built the system to make sure that the auditors will feel comfortable with how the system's managing the data.
Oh, sure. So built in is online grant delivery and acceptance into the system. So that's all electronic. And then there becomes a PDF that's rendered once all the parties have signed, and it's stored indefinitely on the system as well. So we don't just, get rid of grant agreements as soon as vesting has happened or any of that kind of thing. All those documents are stored indefinitely. They're retrievable by the administrator, but they're also retrievable by the participant in case they want to look back at what they signed. They want to share it with an attorney, an accountant, a financial advisor, or whatever the case may be. The participants can retrieve those themselves as well, but they remain unchanged. And they're also generally linked to the plan document, and that's an important thing to think about when you're creating these grant agreements. What are they linked to? It's generally a plan document, but you want to make sure that that linkage is in there. And that if you make plan changes, you're scanning the grant agreements to make sure any new grants are reflective of any plan changes that you've made as well. And then, of course, having all of that stored so the auditors can sample, again, a reasonable size or a reasonable number of grant agreements just to see, hey, everything's signed, the dates are right, everything matches up. You had all the, again, the aforementioned qualifications to this is a grant. Everybody knows what's happening here and everybody's agreed to it. So all of those things are memorialized in PDF in our system, and it's certainly in most systems, I would argue.
Yeah, I've actually seen systems that don't do it. Believe it or not, I know of one system, several systems out there that they just don't have a PDF version of their reporting, and I just am like, I don't know how you can do that. I've also seen systems where the grant agreement is always created on demand, so it's not saved as a PDF. So that means if I go in and change it from 1,000 shares to 1,000,000 shares, then when you run it again, I would get a new version of my grant agreement instead of keeping a PDF. So these are the subtle little things you got to really look at when you're buying a system, right?
Yeah, I mean, those sound like control issues to me, and almost, I would say, control holes that you want to be very, very careful of, because then it's just like, how is an auditor to be sure of anything? If that capability exists in that system, they literally can't be sure if it was 1,000 or 1,000,000. And also, I mean, that's bad enough, but then also if you can't see who changed it, but via an audit trail against that field, that's problematic as well.
Yeah. Well, I always like to ask about scary stories. If you guys are willing to share on a no-name basis, a good story. I just published my latest book on the last 40 years in stock plans, and I have a whole chapter on the crimes that have happened in the stock plan world, because we got some juicy ones. But there's the whole Cisco situation where it was, I don't know, Todd, if you're familiar with this, but it was 3 or 4 accountants at Cisco who were going in and granting themselves options. And then, if I granted it to myself, then I'd have Todd sign the letter to the transfer agent saying, hey, Karine just exercised her stock. And they were doing this for quite a while. They ended up going to jail. It's pretty well known out there. And this happened, I think, around the 2000s, 2001. But, this is, I think people forget how much value there is in the stock plan. I mean, it's one thing running the checking account for Cisco, but being able to issue Cisco stock without paying for it, it was millions and millions of dollars. So curious if either one of you have any, no names, confidential stories that you could share where you've seen audits go bad or audits get held up or keep somebody from going IPO or something like that.
I don't really have any stories per se, but if that was pre-2002, that's pre-Sarbanes-Oxley, and 404 established segregation of duties, I believe, and sounds like there were not appropriate controls or segregation of duties. It was more, sounds like you scratch my back, I'll scratch yours, which of course is just an absolute conflict of interest. And in this case, sounds fraudulent as well. So no particular stories, but hopefully today, companies are set up and they've been through 20 plus years of 404, and they're much better equipped to not only do it, but demonstrate through their documented policies and procedures to their auditors that in fact these controls are in place.
Yeah, and I'd say for public and private companies, I think that story, Corinne, illustrates sort of a mindset that most auditors have coming into the audit. How do we make sure we don't become that next story? And how do we design our audit procedures to make sure that we've satisfied ourselves the company has really good controls over this process? So I think in the example you illustrated, system access was probably a problem, as Don mentioned, segregation of duties. It's tough in any environment when, if you get 3 people coming together to try to pull something off, that's hard to build really good controls around. But, low-hanging fruit, I think, for every company, making sure there's no one single person who can get in there and make grants without somebody else having to review and approve those things. I think that's something that every company, no matter your size, you got to take care of the little things like that and keep an eye on system access.
Yeah. Yeah, in an earlier webinar we did with Kelsey, we talked about segregation of duties. We had 2 clients on, and they were talking about how that was the single most important reason they went with Kelsey was that within the company there were a lot of things people couldn't do because they knew Kelsey was independent and outside, and so it made it more difficult. The other thing, I think there was another story, believe it or not, at Cisco. I mean, they were just the poster child for this in the 2000s. But they had a head of corp dev who was doing deals to buy. Cisco at the time was buying a ton of companies, and he would go into the stock plan group and he would say, "Yeah, we're buying this company in Jamaica, and I need you to wire over 1 million shares because that's part of what we're paying for." And these people would say, "Well, I need to ask somebody. We don't have time. It's closed in a day. I need you to do it now." And I think that's one of the principles too of fraud. It's always urgent.
Yep.
And so I think that's another thing that I think I wonder if the auditors are looking at when they're doing their 404 review is if the CEO comes in and tells you to do something, you're going to feel like you have to do it, and how is that all managed? So I do think it is. Again, as you said, Don, a lot has changed since that time and in terms of controls, but I hope the auditors are looking for things like that. Especially, I was going to ask you about private companies. Are they being as careful in a private company as they are in a public?
Probably not is the answer to that question broadly. You and I worked in that space for a while, Corinne, so we heard lots of interesting things, but just starting with Black-Scholes or whatever your valuation is. But I think before we get to the expense and the income statement, it's about, well, how did you value this? And is it consistent? I think another flag might be accounting policy changes. And so it's not that you can't do it, but you better have, a good explanation for it and documentation for it, because what I think auditors like is consistency. And so when you get away from consistency, it's hard to compare year over year and so on and so forth. And within Black-Scholes, there are 6 elements to calculate the valuation of a stock option at grant. And here's another example where a system that does it for you is going to do it consistently. So it's not the Excel spreadsheet that could change when one person leaves and somebody comes in and they think they've got a better way to do it and so on and so forth. Bad control or no control there. But again, if you're in a system like Certain or another one, you just put the grant in, and these systems today, they just run a Black-Scholes for you because all of the information is in there. They calculate expected term. They allow you to put in a dividend if you're a dividend payer. They do the volatility calc. For private companies, if you've got the public comps in there, the system will do a volatility calc based on the weighting of your publicly traded comp companies. And, then you've just got to get down to what's the grant date and make sure that that's correct, because that can be an interesting topic. And then stock price date of grant and make sure that's consistent. So it's, yesterday's close or the average of today's high and low, or whatever it is in a public company. And then, of course, in private companies, we get to the land of 409A. And, what valuation did you use for the company stock price for the grants in a period? And can it pass the sniff test of an auditor a couple of years down the road? Or is it going to look like cheap stock? And so, again, consistency, really important on these data elements and where do they come from. And then, the best idea for a private company is having an independent valuation firm do that company valuation for you, of the company stock price. So there are systems that'll do it algorithmically, but there's really nobody to stand behind that. When you get an independent to do it, they give you a report. You can hand it directly to your auditors. That firm signs off on it, and generally, insofar as I understand, they'll stand up behind it and even speak to your auditors about how they arrived at the fair value of the stock at the date of grant.
And Todd, do you see sometimes with clients that the auditors do want to talk to the 409A valuation firm? I mean, I've heard that. I just wonder if you've seen that in practice.
Yeah, absolutely. And I think Don's exactly right. I just expand that to say, I think be careful what you pay for, or be careful what you're not paying for. I think inexpensive or no cost valuations come with a significant price at audit time. Algorithmically, they tend to do a pretty good job if there's been a recent financing event, so that the company valuation is pretty well established by a transaction that just occurred. But once they start to get away from that, it gets tough. And we certainly, one of the challenges we have with a lot of our clients as they go through audits are objections from the auditors on the approach that was applied. And then getting somebody on the other end of that valuation to sort of answer the call and either make adjustments to it, or even, just sort of be prepared to respond to some of those. Having a good independent valuation partner as part of that process tends to ensure those things don't happen. And unfortunately, what occurs in those situations is by the time the auditors raise some objection to the valuation, it's months or maybe quarters later. And the company's granted a lot of awards under that valuation. And now the auditors are raising some objections, and we're kind of stuck in this spot between, well, we've already put these out to employees and directors, but the auditors don't like the results we're getting from an expense perspective. And how do we reconcile the two without running afoul of one or the other?
Yeah, another one. I was going to say, Todd, you can correct me if I'm wrong here, but as private companies graduate from reviewed financials to audited, it may be that some of these problems are not necessarily becoming exposed through reviewed financials.
Sure.
But when they graduate to a full-on audit, this could be a couple of years down the road after grant, and they've got cheap stock on their hands, and now a true audit is actually uncovering that.
Yep.
And have you seen that happen, Todd? What happens then to those employees? I mean, is this a repricing situation which opens up a whole nother can of worms? Or
I'll tell you what, in a word, it's awkward, because again, we've got these awards. Again, where it really gets awkward is we've granted a bunch of awards under this valuation that our auditors no longer like. And what we've had to do a few times is a little bit of an off the books calculation to satisfy the auditors and get to the correct accounting that we need for US GAAP. But having a parallel system running for really tax purposes, where the company believes that 409 is defensible for tax purposes. And it can just, it's you can imagine, it's not a great place to go. And it's largely triggered by the unsophistication of what was done on the valuation side.
Yeah. And I'm seeing now, I would say 5 years ago, the trend was, especially for private, smaller private companies, buy our software and you'll get the 409A for free. And that always worried me. And Don and I have had lots of conversations how I think it's a conflict of interest. I don't think your valuation firm should be your software firm, because I've been in conversations where I've said, well, the company didn't like the 409A valuation, and the software company said, well, what do you want it to be? Because we don't want to lose the software license business. So I just think that's inappropriate. But the question too is on the 409A is, how often do you see companies reading it, agreeing with it, pushing back, talking to the valuation firm, or is it just a checkbox? Is it just, I got my 409A, now we can grant, I'm not even really reading the report, or are the boards reading the report? That would be another question, because I think people have gotten so numb to 409A, they just think whatever the valuation provider spits out of their system is all I need to know.
Yeah, I mean, I'll certainly say, for our clients, especially where Counsy's involved in helping to manage the accounting process, we're definitely taking a look at those and reading them to make sure we understand the assumptions that have been made. And just as importantly, that the output, what's coming out at the end, kind of makes sense for what's going on a macro basis overall. We also encourage our boards to review and kind of formally approve those before we move a draft 409A to final. So I think that's good hygiene for any company.
Yeah.
I could see a world, in answer to that, Corinne, and especially with private companies, where a founder may dispute a valuation that their valuation firm puts forward because it's their baby and they just think it's worth more. They just believe it's worth more than whatever that number is, maybe even without the full understanding of that in some cases a lower valuation could be beneficial.
Yeah, that was the situation I was involved. The chairman of the board, it was just an ego thing. He was so upset that it was such a low number. And we kept saying, but that's a good thing. And he said, it has to be higher. And we're like, that's a bad thing. So, yeah, I mean, the other thing I was going to ask you is not to be all about 409A, but there are more systems out there now that are going to be do-it-yourself 409A valuation calculations. And I'm assuming both of you would be against that kind of concept for a private company to license some software and do the 409A themselves without using an independent firm.
I mean, absolutely. I think the real challenge with that is, again, if the day arrives where you are going to be audited, and I'm talking about auditing from a financial statement perspective, not an IRS audit, but if you're audited from a financial statement perspective, that valuation that you kind of did on your own is going up against a lot of really bright people that are valuation experts on the audit team side. And that's a difficult conversation to have if they have questions, because it's going to be talking at a level that likely the person leveraging that software isn't as expertised in as that person from the audit firm.
Yeah, our approach is to make it as easy as possible for a customer to get the data out of the system and provide it to that independent appraiser who's going to give them that 409A once a year or when an event calls for it.
So let's just move as we end here to expensing and financial accounting. So in terms of that, Dawn, what is it that you do in Certain to make it easy when it is time to do the expensing? You mentioned, there's all the inputs and that, but any other reports that you have in the system or something that you find are really helpful for people as they're preparing for the audit? Because obviously they're running these reports, but now you're getting ready to explain to the auditor that you did it right.
Sure. Everything's date driven, so you can run any date range that you want. So that's handy if you're doing a quarter, let's say, or a year or whatever it is. You've got the backup detail behind. So I can look at a grant and say, okay, we're expensing this much in this period, but what were the fair value details behind that? We can get to the Black-Scholes assumptions for that single grant, which is handy. We can do cost center expensing. So if a company is set up that way where they want to be able to apply expense to where it belongs because they're set up with different divisions or countries or subsidiaries, any division that they have, you can express in the system and then expense in the system, out to the cost center that you want to. Then the other thing that we do is deliver the journal entries. So you certainly want to have the backup behind those journal entries, but the system will push out the double entry accounting for lots of different things, including tax as well. But on the expense side, it'll give you what you should put in the general ledger based on what the expense is for the period. And so lots of auditability there. What's behind that number? It's like the question is, I see that number there, but how'd you get there, right? That's kind of one of the quintessential audit questions, and the system just has all the backup reports, hundreds of reports. So all the backup that you need as a customer to answer that question. And in fact, if you're prepared, you've got all those reports run already, and essentially, you're just kind of handing them over to the audit team when they come in.
Yeah, and then of course there's always the oops, we forgot to add this grant in. It was in the board minutes. We reviewed the board minutes, and you've already run. Let's say you're publicly traded. We've already run your numbers. How do you handle that in the system?
Yeah, so that's a really good question. And of course, you don't want a restatement, right? So what we allow you to do is put the grant date in based on the contract. And it is a contract. That grant agreement is a contract. It needs to be treated as such. So if, it's this year and it was a February 16th grant, we'll allow you to put that grant in at February 16th and start the vesting, but the first quarter will not take any expense because you didn't put it in. It'll do a catch-up entry in the second quarter and then just go out either ratably from there or whatever your expensing policy is.
Okay. So just as we finish, maybe I'll ask Todd and then I'll ask Don. Just your final thoughts in terms of if you're the person who's preparing for the auditors, they're showing up in 3 weeks. What very tactically would you be doing right now with the next 3 weeks to prepare for the auditors to arrive?
Yeah, so I can start with that. I think getting in front of the more complex issues, it's not really difficult to figure out how the auditors are going to approach the audit. So getting in front, they're going to be focused on the unusual transactions that occurred during the period. So getting in front of those early and getting to some answers that you can bring to the auditors early, I think is probably the single best advice I could give to everyone going through an audit.
So
as I mentioned before, go
Todd,
ahead.
how would they know that these are the complex? I mean, are you the
Sure.
one who brings that report and goes, by the way, here's the 10 things you really should look at because they're complex, or are they coming in and saying, we hear from the minutes that you did this?
It can be both. So it can certainly be somebody like our firm from a technical accounting perspective doing a review prior to the audit to kind of help companies navigate what those complex issues are going to be. But absent that, I think it's just what are we doing that's sort of outside the normal course of business. So again, a grant of a sort of plain vanilla award, not that we don't need to make sure we're doing that correctly, but that's something the auditors are going to test more on a sampling basis. But if we're doing some really unusual awards, performance-based awards, market-based awards, we're doing some modifications where we're repricing awards, or we've got a key executive that is terminated and there's been some significant changes to awards that they held as part of their severance agreement. Those are the areas of focus that I think the auditors are likely to look at. And one thing I would caution everybody is in the first few weeks of the audit, you may not hear any requests from the auditors about those particular things. I would not declare victory and say, oh, well, we got by with that. Sometimes those things take a little while to percolate on the audit side until the senior manager or the audit partner gets involved in doing their reviews. And that gets to be painful when those types of questions come up at the very end of the audit and we're rushing up against some filing deadline.
Yeah. I cannot say this enough because I'm on a number of boards. The equity comp stuff seems to happen at the end. I see this happen all the time where the audit's doing really well. And then that last few days, all of a sudden, everybody's like, whoa, they're asking questions about equity comp. And I'm like, were you guys not ready? I mean, this is.
Yeah. And that's why I think it's important to just get in front of those and raise them early, because in the early weeks of an audit, it tends to be the junior folks on the audit that are doing the ticking and tying and trying to digest all the reporting that we've gave. It's not until later when the senior managers and the partners get involved and they go, hey, wait a second, what's this? Mm-hmm. How come we haven't looked at that yet? And that tends to be painful in the 11th hour.
Yeah. So almost like, if you sit there and say, well, they never asked me about it. So
right.
It's not over till the audit's signed off. So be prepared and be honest, and say, hey, we had a really weird thing happen this quarter. We want you to be aware of it. And here's the backup data. Don, how about you? Any final thoughts as people get ready?
Yeah, Todd touched on it. The performance stuff can be really, really, really tricky. You may, depending on how things are going, you may have incremental or decremental expense in the period. And so I think it comes down to how are you measuring it? What are you measuring? Is that consistent? Is it consistent with what the grant agreements say? You got to be able to back that up, because it's not like, okay, straight line vesting 4 years, 25% a year, pretty easy. I can do that in my head. performance vesting, very, very different. And the prevalence of it is at least 60% in publicly traded companies, if not more. And then the flip side of that, on the market condition, you really should have a professional do the Monte Carlo for the market condition, and then make sure you follow the rules about, reversing expense and so forth, because it's different than straight performance conditions. And make sure your system's up to that, and understands all that, and that logic is built in. So yeah, I think performance grants in general, it gets really tricky, and that's one hot spot to really look out for.
Yeah. Well, this has been, I think, so helpful and so practical. I really appreciate both of you guys spending time, and you both have so much experience. I hope our listeners have learned from that and know that, the audits are going to happen. You need to be prepared, and you can hopefully get through it without too much pain. It's just people asking good questions and you being prepared to answer them. So really appreciate it. I think if anybody has any questions, I'm sure they can reach out to both of you. We'll be putting the QR codes up here at the end of the webinar. And again, want to thank you and wish all of you who are preparing for your audits now. I guess it's a little late, right? It's April now, so maybe you're good for another year, but good luck on all of that. And thanks again. Take care. Have a good day.
Very good. Thanks, Karine.
Thanks, Karine.
We thank you for joining us today, and we hope you enjoyed the discussion with Don, Todd, and Karine. For more information about these speakers, please scan the QR code for their LinkedIn pages or visit us at countsy.com. Please follow us on our LinkedIn page for updates on upcoming webinars, and we look forward to seeing you at our next one. From all of us at Countsy, thank you again, and have a good rest of your day.